Welcome back to Think Change. It's our first episode of 2026, and I'm your host, Sara Pantuliano. In our final episode last year, we discussed how fragmentation is deepening, trust is eroding, cooperation is becoming more transactional. We're seeing rising geopolitical tensions. Look at the events of last week. More economic turbulence, climate shocks, widening inequality. The world feels increasingly uncertain. And so leaders, investors, development practitioners are trying to figure out how they can direct resources to make a real difference in a world where the stakes have never been higher. Well, with the annual meeting of the World Economic Forum gathering in Davos just around the corner, this question is front and center. One idea that's captured attention for a while is impact investing. The promise that capital can deliver both financial returns and measurable social or environmental change. But beyond the headlines and the many commitments we've heard over the years, how much of this promise is actually being realized? Are we seeing real change on the ground, or are we still navigating the gap between rhetoric and reality? Well, in this episode of Think Change, I'm joined by three voices who really live at the intersection of investment and impact. I'm joined by Dorothy Nyambi. Dorothy is the president and CEO of MEDA and brings practical insights from supporting sustainable enterprises on the ground. Along with Dorothy, I have Amit Bouri, co-founder and CEO of the Global Impact Investing Network. Amit has helped shape the standards and the tools that really define impact investing globally. And last but not least, our own Neil Gregory, senior advisor to the Center for Private Financing Development at ODI Global, who examines the evidence behind what works and what doesn't work when finance is meant to drive social change. Dorothy, let me start with you. These days, development is increasingly speaking the language of capital. If you look at MEDA's work across Africa and other emerging markets, how is this shift from grant-based aid towards investment-led support changing the outcomes, particularly for micro, small, and medium enterprises? Where are you seeing risk-tolerant capital genuinely unlock growth?
I think, where I want to start is that at the moment we're looking at aid is shrinking, but the reality is the need has not shrunk. And where we sit as MEDA, we really don't look at this as a funding gap. We look at it as a systems failure. Because money is only one part of what a system needs to be able to do the work that it needs to do. So the traditional aid was built on a scarcity mindset. People don't have, and so you're going to come in, and help to fill that scarcity space. Today's challenge for MEDA, we say, is about wealth creation. And that for us is where it's about wealth creation with dignity. And that's where the micro, medium, and small enterprises fit in, right? So, because at the end of the day, money is meant to be able to get to these businesses. These businesses will thrive, and that's what builds an ecosystem of prosperity. I'm not talking about a specific sector, across all sectors. And so at MEDA, we look at it and we say the difference is really not about how we replace aid with investment, but it is the different instruments for different problems. If you look at that ecosystem, take a systems approach, each of those parts of the system need a different kind of instrument. And that's where MEDA says, we don't come in with money first. We look at that system, we look at what is needed so that the money is structured to fit different parts of the system and everything. When it comes to risk tolerance and everything, I think where we are today, the issue about risk tolerance is very much about the money not being shaped to meet the needs.
Yeah.
So there's a lot of money for impact investment. They're very risk adverse. But at MEDA, we've taken that first port of entry, the first loss, the unbankable, looking at that spectrum from what do micros need, what do medium size need, what do small enterprises need. So we've taken the whole of that spectrum so that the money which continues to come into the impact investment space doesn't continue to go to the usual suspects. And if the usual suspects are not working within a system, they themselves would not survive. The advantage we have at MEDA is that we work in Sub-Saharan Africa, Latin America, and the Caribbean, Southeast Asia, and the Pacific. And we can see the difference when you take a systems approach to how you play with capital, like what's happening in a little bit better more in Southeast Asia and Latin America and the Caribbean compared to, say, Sub-Saharan Africa. So with that, we really believe that it is so important to look at investments for SMEs, not just as a risk, but as we're actually building and investing so that, these small enterprises can thrive. So I'll stop there for now, but just to say we're not using money to drive, our approach. We're using the system to determine what kind of money is needed within that system.
Thanks. Very, very clear, Dorothy. Excellent. And Amit, impact investment has really moved from the margins to the mainstream. We're seeing more and more participation from institutional investors, from philanthropists. You've been at the heart of, steering a lot of this shift, really. This field better than anyone. Where do you think impact capital is really delivering additionality? And where are the claims overstated?
I think with impact investing, we see a continued rise on the global agenda, particularly in light of what's happening all around the world, where we do see traditional resource flows diminishing in some ways. But we also, as Dorothy put it, the need is not. So the big question is, how do we want to solve problems? How do we want to advance prosperity and a healthy, sustainable ecosystem? Now, where impact investing fits in is I think it plays an incredibly critical role in extending the reach of markets. So if you go back 40, 50 years, and you talk about international development, the only kind of private investment in town that was coming from abroad was typically, DFIs when they were and that's why they were set up to do is to help put private capital to work in emerging markets. We now, and that was complementing aid, but of course, it was all coming from the backing of governments. Over time, we've seen the shift towards private capital continue to increase. However, private capital will typically flow towards the path of least resistance. So it's economies that are more established, companies that are bigger, markets that are more developed, where margins are higher, and so on. And we see this all around the world. And what's important about that is it's optimizing around how to make money most efficiently for the investors, which, in the capital markets have been effective at doing that. Where impact investing, I think, challenges this broader kind of paradigm is setting a different set of objectives for investment. So they're investments that are made specifically with the intention of creating positive, measurable impact alongside a financial return. And that's where we see effectively, impact investing is helping to, address unmet needs based on the kind of the dominant traditional paradigm of how investment capital flowed around the world. So inherently, it is trying to extend the reach of markets. And, it did start as a very nascent concept and has now become much more mainstream due to the efforts of many people in our network and many collaborators around the world. And I think it's incredibly important because if we are to achieve the Sustainable Development Goals in whatever time frame we're aiming to do so, and if we're actually trying to solve these kind of systemic entrenched issues that we see in markets all around the world, where people need better housing, we need more sustainable agriculture, we need healthcare, we need economic development for distressed communities. We have to change the way capital flows. And that's where I think impact investing can be quite powerful. And as we see, aid budgets declining in many parts of the world, there's a growing orientation towards how impact investing can help fill that gap. Now, the big caveat, though, of course, as you point out, is how do we actually make sure that impact investing isn't overhyped? And because it is not a direct replacement to aid. As Dorothy mentioned, it's a specific set of instruments. It's loans, it's equity, it's other instruments that are designed for specific contexts and purposes. And investors need to get paid back in some form. And I think what's really critical is making sure we know the right role for impact investing in this broader ecosystem. We make sure that private capital plays as great a role as possible in delivering positive outcomes, but we don't treat it as a silver bullet that will solve all problems and diminish the need for great governance locally or internationally.
Thanks, Amit, and that is a very fair assessment. And Neil, you've also been at the heart of all these conversations from the start. You've also been part of, in a way, helping this shift towards a greater investment-led approach. And you've been analyzing the evidence around that. What does the evidence tell us about how these shifts are actually reshaping the political economy of development finance, especially the balance between public purpose and private return? As Amit, has just said, investors want to be paid back. Where does the balance lie? How is this, impacting the way in which resources are put on the table?
Thanks. It's an important conversation, and glad to be joining it with Amit and Dorothy. I want to build on a couple of things which I think they've raised already. And I think the starting point underlines something Amit said, that we shouldn't think about private investments, whether it's from impact investors or commercial investors, as a substitute for aid. Most of what the aid which has been cut was financing, was things which, to be sustainable, need to be financed from government budgets. So cuts in aid really mean that governments need to step up their domestic resource mobilization and finance these programs from their domestic resources. But already going back to the Addis Ababa conference of finance for development, as far as 2015, there was a recognition that the scale of financing needs for the SDGs, for climate change, is going to be beyond the capacity of governments to finance. And so you need to utilize all sources of finance. And there are large pools of commercial capital, there are large pools of philanthropic capital, which can be mobilized alongside government finance. And this has been an important part of the financing agenda even before the current round of aid cuts. I don't think it's really affected by that. And I wanted to build on what Dorothy said about her focus on wealth creation, because I think in some ways in this current discussions about where do we go next in development, we do need to sort of come back to the basics, that the most important thing that private investment provides in an economy is good, productive jobs that creates incomes for people and also creates the tax revenues which allow governments to provide public service, to provide health, education, and meet people's basic needs. So I think sometimes people have, over high expectations that impact investing is going to solve all kinds of social problems directly. And sometimes I think we need to keep in view that if it can just meet the financing gaps for small and medium enterprises that are creating good jobs and raising the productivity of poor people and providing much needed goods and services to low income communities, that is really the central role that private investment can play in an economy. And you see that at the development banks, how the World Bank Group has refocused its mandate around jobs. And I don't think that's really a change from what it's always been about, but it's kind of coming back to basics, that this is really a core role, particularly for private investment. And so the last point I want to make is that I think there's a complementarity between larger commercial investors and impact investors. Increasingly, we're finding ways to structure investments so that you can use different types of capital with different risk appetites and different impact objectives. So there's a big role for impact investors to take higher risk positions in these structures alongside commercial capital. But in all of this, what we find is missing is often the supply of new investment opportunities and the growth of new firms that can be invested by these structures. And so I think there's also an important role for impact investors in nurturing the growth of new firms so they become productive and investable by commercial investors.
Thanks, Neil. I mean, listening to all of you, I mean, I can see that over the years we've seen this promise, better realized in some sectors, in some, markets are a bit more stable for certain type of, enterprises. But as you've all alluded to, it's often hyped as the silver bullet, as the solution for the shrinking resources in aid. And one thing in particular we can expect from the Davos discussions, we've often seen this conversation focus on how to scale private capital in frontier and emerging markets, and especially for micro, small, and middle enterprises, the ones that remain really chronically underfinanced. But Dorothy, you were talking about the importance of the system, and in some of these frontier markets, that's really where the challenge is greater. What do we need to have on the ground in terms of institutions, in terms of capacity, in terms of governance for these inflows to really translate in genuine growth?
Yeah, no, thanks again for the question, Sarah. And just building on what I think first Amit said about this is not a replacement for aid, right? There are two different boxes. I think it's important that we keep reminding the audience that we're dealing with two different boxes. When it comes to what we see on the ground or what works on the ground, I think first of all is that the capital needs to arrive early, right? Sometimes capital comes in too late. The capital needs to arrive early. Capital needs to be patient, and stay, on the ground. And capital needs to be able to absorb risk. So at MEDA, we absolutely come in there, as early as possible, and really ready to absorb the risk and be risk tolerant. As I said, we work in Latin America, Southeast Asia, and Sub-Saharan Africa. But I'll give the example of the MasterCard Foundation African Growth Fund, the $200 million fund in Sub-Saharan Africa, which is, we are in the fourth year, and there's all the evidence of how much we have unlocked growth by being able to absorb risk, come in there, patient, catalytic, take first loss positions with intermediaries, that are ready. And then they can now go and work with SMEs, MSMEs that ordinarily would not have been bankable. But we are looking at the entire system, Sarah, because even an SME to survive in every part of the world, including in North America where I sit, the ecosystem within which that SME is sitting has to be ready and able. And those are the policies, the laws, the other items that allow for SMEs, whether it's trade, supply and demand, those equations to be in place. So for us, it is really about getting the capital on the ground in time alongside that holistic view of what else needs to be on the table. The last piece I just want to say is that when we bring in capital, we also say it's impossible for one organization to have the solution. So partnerships have become a key and central element of the work we do. And we're looking at additionality, complementarity, and we're not talking about contractors. It's about partnerships, which is a very different concept from just hiring a contractor to do something for you. So that's a little bit our experience on the ground, but saying that it is working if you actually come in with intentionality and give yourselves time.
That's really interesting that you're bringing the philanthropic capital, really talking about how it's, positioned as catalytic, absorbing risk, in many ways shaping markets. I mean, this is becoming more and more of a feature, but how should philanthropists really balance, this ability to be flexible, to move at speed with accountability, because they do have a growing influence over developmental priorities?
That's a great question, Sarah, and it's something we think a lot about at the GIIN, because one of the things with mainstream capital is it can move great sums of capital, but it tends to be fairly rigid in terms of what it does, because there's certain norms around how big a check needs to be and what the structure needs to be that for any large investor of a pension fund or an insurance company, any big allocator of capital will use to fit things into grooves and boxes that make sense to them. But of course, when we look at the needs on the ground, they don't always naturally fit into those boxes that you'd use for large investors. And that's where flexible capital becomes incredibly important. Now, there are only a few potential sources in the world of flexible capital. One, of course, is some government-backed capital, whether it's development finance in whatever form it takes, philanthropically backed capital. And then we also see a role for families, and high net worth individuals who are essentially investing their own family's capital. And this flexible capital is incredibly important because it helps to One, seed new models. It could be new models, for example, on how to structure something for housing. It could also be new models of more regenerative agricultural models on the ground that aren't yet proven at a scale that could draw on mainstream capital. This type of innovation in processes and models is incredibly important. And it's important to help demonstrate what's viable and what the track record is that can then attract greater capital over time. So we see philanthropies and wealthy individuals playing a critical role. If they're mission driven and are trying to figure out how to solve a problem as their first and foremost goal, and may have more flexibility around the terms and structure of how they make their investments, that can be very powerful for developing the solutions of tomorrow. Now, this point about accountability is important. And it's something that we've always talked about in international development. Two things that I think are really important that can help with this. One is that when we define the core characteristics of impact investing from the GIIN standpoint, one of those characteristics is that it's responding to needs on the ground, that the solutions are evidence-based. So they're actually financing something that will help address an unmet need. Now, the fact that this is investment does bring a market discipline to it. So if you build housing that people don't want, the housing won't work, right? People aren't going to pay rent and so on. And so there is a good discipline that I think is inherently built into an investment model that can be valuable in this case. We also think it's very important, though, for investors to measure and manage their impact. And we've developed resources like Iris Plus, and we now host the operating principles for impact management, which Neil helped.
Maybe explain a little bit for the audience what this is all about.
Absolutely. So Iris Plus is a system for measuring, managing, and optimizing impact. So it's really designed to help investors, start with a global goal, like a sustainable development goal. Identify the strategies that can help them reach that goal, and then identify the specific metrics that they can use that we've run through a kind of a global process to develop that will help them say that if we're trying to promote, for example, increased financial services for female entrepreneurs, here are the specific definitions and metrics you could use. Similarly, if you're trying to increase access to household solar, here are the metrics you can use. And they're common metrics used by many investors all around the world. So it allows investors to speak the same language when it comes to impact, and then also avoids the issue of efficacy and of if investors are just making up their own metrics, which doesn't get us to a market that solves problems at scale. Now, the impact principles that I mentioned are really around how do you integrate impact measurement into the investment process. And so it's 9 steps. There's more information on our website, but we have over 180 investors around the world who have signed on to be signatories of the operating principles for impact management that are incorporating this into their process. But these are 2 different and very complementary ways in which investors can both create better processes and approaches, but also have better accountability to all stakeholders around how they're approaching impact investing.
Thanks, Amit. And listeners can find details of all of this in the show notes. Neil, Amit said, you've been party to developing some of these mechanisms. How do you think they're working? Are they really helping create a shared language?
So I think it's been important to develop these standards so that there's clarity for investors as to what differentiates an impact investment from other types of investment. We've seen what happened to the ESG investing space when there wasn't clarity. It was oversold, it was overhyped, and then you had the backlash. I think the contributions of the GIIN and others, we've been able to avoid that backlash in impact investing and protect the integrity of it by allowing the impact fund managers and DFIs to agree on a common set of practices that ensure that you are genuinely focused on an intent for impact and you're measuring and managing to achieve that impact. So we've avoided the impact washing that people are otherwise concerned with, and this allows you to attract more capital to the space. And then the thing I want to emphasize is that there's a spectrum of approaches. Different investors will have different risk appetites, will have different impact objectives, they'll have different financial return requirements. And this is all highly complementary, and there's room in the space for a range of investors. I think Amit highlighted some of the roles for impact first, highly risk tolerant, smaller family offices. We need those types of impact investors. We also need large pension funds and insurance companies that have a fiduciary duty to achieve a market rate of return. But if they can combine that with achieving measurable impact, that's something that their stakeholders want them to do. Particularly, we see that amongst European pension funds. And we do have evidence that well-managed investments in emerging markets, if you are patient in the way that Dorothy described over a long period, can actually produce market level returns. It's not something that's easy to do and it doesn't happen overnight, but in the long run, you can do it. So I think what we're talking about is ensuring that we continue to provide investment opportunities that offer both measured impacts, and this is where IRIS comes in, ensuring we have good measurement, and which have that credibility that they're really being managed to deliver that impact alongside a range of different risk and return profiles, so that we can mobilize capital from the widest range of investors to meet the huge financing needs.
Thanks. We need to draw towards a conclusion, but just want to ask all of you. You've all said very clearly, that private finance is not the solution to the current development financing gap. That it needs to complement and not substitute the role of the state. Can you share with our audience, some examples of where you've seen that, work really well? What are the examples that we can build on, and also what the guardrails should be, to make sure that it does become a substitution, but it's really there about, complementing. Who wants to start?
I'll give a quick one. I think, huge need for the private sector development in sub-Saharan Africa in particular is reliable access to low-cost power. That's been a huge constraint. That is largely being addressed now by renewable energy, wind and solar, and a lot of that is commercially investable. We're seeing a lot of private investment in that space. But you need to complement that by public investments in transmission and distribution, which are much less easy for private investors to take on. So I think there's a very clear complementary role, and now you have this global initiative led by the African Development Bank and the World Bank and others to really scale up financing in power generation in Africa, and it will provide opportunities for impact investors, for private investors, but you will need public investments as well.
Thanks, Neil. Amit, as you come in, can you also deal with, another question we've often faced when talking about impact investment is, this de-risking that Neil is talking about, is it not a subsidy to the private sector? How do we avoid that usual refrain?
Sure. I think one thing that's really important when you talk about guardrails, of course, is clarity. Being clear about goals and being clear about what is impact and what isn't. Governments have a very critical role to be playing in terms of what the social development agenda is, what success looks like. We have things like the Sustainable Development Goals, which give these very big, high-level goals that people can anchor around. And when it comes to this additional question you raised, Sara, around how to think about subsidy and things, one thing I think is really important is to anchor on the right metrics for what success looks like. And then from the perspective of someone who's providing first loss capital, you could see it as a subsidy to the private market, and effectively it is in some regard. The people who are advocates of it, they will see it as leverage. So by putting in $1, I can get 10 additional dollars invested into this area towards this goal that's important to me. So if you're trying to think about how to create jobs in agricultural communities, how to increase access to finance for small businesses, how to make sure more people get shelter and housing, getting a 3x, 5x, 10x multiplier is incredibly attractive because these are huge goals, hugely important, but also require a lot more financing. But I think the discipline about being clear about what you're trying to accomplish, making sure the partners are aligned and it's measured, I think is a really great grounding and mooring for these types of partnerships to make sure that they're working along similar, kind of North Star.
Dorothy, and you've brought that into practice in so many places. Over to you for the last comment.
Yeah, and I think for me, what I'll say is that, the guardrails that we want to make sure in place is that, the kinds of investment we do, philanthropic, private, sector capital that we bring in does not replace public capital and public investment. The kind of capital we'll bring will never build roads. It's not the one that's going to build a big hydroelectric plant that's going to supply power that the SMEs need and everything. And so with that, it is really about complementarity and being able to see where the capital that we bring in fits and what the role of the public sector is. We need policies, we need laws and regulations, and those things are brought in by the public sector. So for us, we don't want to say we replace the role of the state. It is about additionality and complementarity. It is about that partnership, and not, competition or trying to exclude the other. So, and I just want to add that, the MEDA is signed on to the GIIN IRS in terms of, the piece you talked about, accountability. And we really believe that you can have purpose and profit in the same sentence, right? And that purpose and profit in the same sentence is what allows us to, when we talk to philanthropies, family offices, they can come in. And that's what I think I wanted to jump in to say. We look at philanthropic capital as being the architects of the market and not just only actors. They help to fund those things that private profit-only capital will not want to fund, but which is needed to build a system so that profit and that kind of private capital can succeed, within the ecosystem.
Well, thank you all so much. I think today's discussions has made clear, if ever there was a need, that impact investing has an important role to play, but it is not a substitute for aid and is not a silver bullet for the development financing gap. I think as Dorothy, Amit, and Neil have all underlined, different problems require different instruments. And private investment can help extend the reach of markets, can help support small and medium enterprises, and can create productive jobs, but it is there to complement and not replace public finance, strong institutions, and effective governance. And credibility depends on clarity, clear intent, clear guardrails, and clear measurement of impact. These questions sit at the heart of the work of the World Economic Forum Global Future Council on Reimagining Aid, of which Amit and I are both members. The Council is grappling with the critical inflection point that is facing development today. This moment presents a stark choice: continued drift towards irrelevance or a fundamental reimagining of how development finance and global cooperation are designed and delivered. So as debates continue in Davos and beyond, the challenge is not just mobilizing more capital, but using it in ways that genuinely deliver impact on the ground. You can find everything we have discussed in the show notes. Thanks for listening to Think Change.